Hey, it is 12 noon on Wednesday, which means it's time for Ask the Instructor. This is our show where we help you understand in much greater detail everything you need to know, not just to pass your real estate exam, but also to greater comprehend the real estate industry in general. I'm John Christman, and the show is brought to you by the Tampa School of Real Estate. If you're interested in starting or enhancing your real estate career, give us a call. The phone number is 813-928-0106. Again, that's 813-928-0106. You can also visit our website at tampaschoolofrealestate.com. And while you're there, make sure you check out our Success Center. We've got a bunch of other great videos like this to help you pass your exam. We've got a great exam prep tools. If you're thinking about starting a career in real estate, check out our licensing programs. We're the best, easiest way to get your Florida real estate license. So definitely check that out. And what we're talking about today, it's called Prorations. Prorations. So proration, this is typically done at the time of closing. So this is typically done at the time of closing to make sure everyone gets their fair share. So let's imagine a little bit of a number line here. So here we have January 1st and December 31st. So we have a calendar year. Now the biggest thing that gets prorated on almost every single property sale, or that should get prorated on almost every single property sale, otherwise someone's getting cheated out of some money here, is for property taxes. This is going to be one of the big ones that we're talking about today, is how to prorate property taxes, how to break up property taxes to figure out what the seller's fair share and the buyer's fair share of these tax payments are. So let's say if our closing's occurring, we'll say this is May 30th. So say if closing's occurring on May 30th, this is the time when the seller's in the property. This is the time when the buyer's in the property. Now the taxes for the current year, they're assessed and the lien's filed on January 1st. So January 1st of the year, the taxes are already attached to the property. And the appraiser says already taxes for this year are so many $1,000 or so many $100 or so many tens of thousands or hundreds of thousands of dollars. And that number doesn't change. This property could get bought and sold 20 times, and it's always going to be the same tax amount that gets billed on January 1st. This is where they say, okay, taxes are going to be this amount. Now, the only time taxes can be paid is right here at about November 1st. November 1st, at least in Florida, is going to be the first date that you could pay your property taxes. This might vary if any of you guys are watching from out of state, but in Florida, on November 1st is the first day you could pay your property taxes. So anytime you're buying a property up until November 1st, there's going to be unpaid property taxes. Now, sometimes taxes will already be paid in here. But typically, if the seller knows they're selling the property, they might pay the taxes, but they might be like, whatever. Screw it, we'll leave it for the next owners. They'll worry about paying the taxes. We'll have a new home we're out to pay taxes for. Ultimately, with this proration, it should all work out. For the time they live in the property, they're paying for their portion of the taxes. The time the buyer's in the property, the buyer's paying for that portion. But who's the person now that's going to get stuck paying the entire bill? That's our buyer. The buyer, unless we have a property that's being sold after November 1st in this small little time frame here of November 1st to December 31st, that's really the only time taxes are going to already be paid. And if that's the case, then we're usually prorating to go to the seller for what the buyer owes the seller for the taxes that they already paid for this time that they're going to be living in the property. But if the buyer's living in the property here, they're going to have to pay for this entire year of property taxes. But what they could do is make sure they get a proration so the seller kicks over their fair share of property taxes, because that's ultimately what we're trying to do with prorations. We're trying to make sure everyone gets their fair share. The seller's transferring over to the buyer. And now whether this is property taxes, which is what we're talking about here, if we just change the dates to a month, let's say we're just now dealing with January, let's say January 1st to January 30th, this could be for prepaid rent. This could be an exact same proration we're doing for prepaid rent. This is the time the seller owns the property. This is the time the buyer owns the property. The seller's got all the rent money. The buyer's probably going to want some of that rent money that they collected at the beginning of the month. Now, if it's right there directly in the dead center of the month, it's an easy split, 50-50 for the rent. The seller gets to keep half the rent, and the buyer should be entitled to the other half of the rent. But now, where this gets a little bit tricky and where your math is going to be able to help you out with this is when we don't have a day of closing that's exactly dead center. Not dead center of the year for taxes, not dead center in the month for prepaid rent, and we could also do this for assumed interest on an assumed mortgage. Now, I know this doesn't happen very often, but it is another type of proration you could come across. But definitely the property taxes, that's going to be the number one you want to know. Prepaid rent's another big one. If you're ever dealing with investors, you definitely want to know how to figure out calculating this prepaid rent, making sure you're ending up with an accurate number there. And it's overall a pretty easy concept once you kind of start to understand all of this here. Now, the way this appears on the closing statement, because when this is going to be entered in on the closing statement, it's almost always, for any sort of these common prorations of property taxes, prepaid rent, and assumed interest, it's almost always debit to the seller, credit to the buyer. So there's these two terms here, debit. If we think of that term debit, kind of like a debit card, use a debit card to pay for things, that's going to mean that you pay. This is the same exact terms you'll see in any sort of accounting where they use debits and credits. Debit means you have to pay. And the opposite of that is going to be a credit. And you can think of this, if you've ever been issued store credit or you get a line of credit, that's where someone's giving you money. So that's going to be receive. That's going to be where you receive money as a credit. So typically the seller has to pay money to the buyer. Now, whether this is prepaid rent, because if it's prepaid rent, which rent is almost always prepaid, I don't think I've ever came across where rent is paid at the end of the month. You get to live in the property and then pay the rent. No, the landlord usually wants the rent up front. So if the seller has all of the rent here, all the money is tied up over here, the seller already collected all of this money, we need to go ahead and give some of this money to the buyer for the time they own the property. So what we're doing when we're putting this on the closing statement is we're recording debits and credits for the transfer of money. We're transferring money from the seller's paying, and the buyer's receiving. So it's a debit to the seller, credit to the buyer. And that rule almost always holds true, especially with prepaid rent. The only time it's the opposite is if the rent's collected at the end of the month, which I've yet to see anything like that. If you have any arrangements like that, let me know, because I'd love to hear more about that, where you get to live in a property or run a business in a property or whatever it is that you're renting and then pay the rent at the end of the month. So that'd be pretty interesting to actually hear about. Property taxes. Property taxes also follow that same rule, almost always debit to the seller, credit to the buyer. The only time is when we're past November 1st. The only time it even has the potential to be a debit to the buyer and credit to the seller is where the seller already paid the taxes, and now the buyer has to reimburse the seller for that portion of the year that they're going to live in the property, albeit very small, because this can only occur if the property sale is transacting between November 1st and December 31st. So that's the only time you could ever have this reversed for your property taxes, is when the taxes have already been paid. But typically they're not paid, so again, it's a debit to the seller and credit to the buyer. Now we're going to take a short break, but now when we come back, we're actually going to get into solving out the math for a property tax proration. So stick with us. I'm John Chrismo, and you're watching Ask the Instructor.
When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment. Need help preparing for your exam? We've got you covered. Join us for a structured weekend review class where we'll cover the topics you need to know to pass your class and state exams. Class sizes are limited, so reserve your seat now by calling 813-928-0106 or registering online at tampaschoolofrealestate.com. Have you been thinking about starting a real estate career, but are struggling to find the time to go back to school? Allow us to introduce our revolutionary online course platform. At the Tampa School of Real Estate, we have used our years of education experience and student feedback to bring you the finest and best online course. Visit tampaschoolofrealestate.com. That's tampaschoolofrealestate.com, or call us at 813 813-928-0106. That's 813-928-0106 to learn more and register for our online course today. After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. Every Wednesday at 12 noon Eastern Time, we help you understand topics that you may see on your licensing exam. And regardless of whether you're taking your exam here in Florida or throughout the country, you can actually get a Florida license through many of the Pearson VUE testing centers throughout the country without even ever having to step foot in Florida. But these topics are also great to know for a lot of your other state licensing exams. A lot of the states also want you to know how to solve prorations. And not even that, not even just passing the exam, but knowing how to explain this to your buyer or seller, how they might have to pay some extra money at closing, or the buyer might have to pay money, but they might be receiving money in the form of prorations, and how much they could expect, at the very least, take away from this. That the further back we get to the year, at least with property taxes, which you're going to run into with pretty much every property you deal with, there's going to be a property tax proration, or there should be at least. The further we get back in the year, the more money the buyer is going to get reimbursed for, so that's going to help them out with cash at closing. Now, ultimately, they should be setting this money aside for when they actually do have to pay the property taxes on the property, but let's be honest, they're not going to do that. They're going to use it for their down payment, and then they'll scrounge up some money somewhere when they do need to pay their property taxes on the property, or they're going to get a tax certificate issued against them. But anyways, I did promise you guys we're going to go ahead and go through and solve a property tax proration. So not just any type of proration, property taxes, which, like I said, are going to happen pretty much any time. Now, when you're doing property tax prorations, there's some key information that you're going to need to know. So what you need to know are, number one, the tax amount. And now this isn't going to change for the current year. It's not going to change for the current year. The next year when the buyer's in the property, they could have completely different taxes. So it's very important that you let them know that their taxes are going to change year to year. But you could just go look in the public records. If you're here in Hillsborough County, you go to hillstax.org, and pretty much every property assessor website, every property assessor across the country has a website you could go on to look up these taxes if you're not already finding it through the MLS tools, the Realist, and everything like that. You could find this tax amount. So let's say our tax amount is $5,493. $5,493, and you might say, why did you pick such an odd number to show as an example? Well, you probably will have strange, weird-looking numbers like this that don't make much sense out of anything for the taxes. A whole nother story on how they come up with this number here. But today we're just trying to figure out how this breaks up at the time of closing so we can make sure our buyer gets credited a little bit of money for their closing costs to really help them out and kind of help offset maybe some of the title insurance they have to pay for, or maybe some of the title fees or anything like that. So tax amount, $5,493. What else we need to know is the date of closing. And so our date of closing, let's say, we'll use what we were talking about at the beginning. Let's say we're using May 30th. Now, the one more thing that's going to be crucial, really, for solving this is going to be knowing who the day of closing belongs to. So it can be any time where the seller has to pay for this day or the buyer has to pay for this day of closing. That could be something that is negotiated. Now, we're only talking about the difference of one extra day here, so it might not be a huge extra little bit of money. We're actually going to find out what the daily rate is and what every single day is worth in the amount of taxes. But you want to definitely pay attention to who the day of closing is charged to. So let's say the day of closing is charged, this is the important part, to and you want to see whether it's the buyer or the seller, we're going to say it's the buyer that has to pay the day of closing. So day of closing charged to the buyer. That means May 30th, the buyer has to pay for taxes on May 30th. If this said day of closing is charged to the seller, that means the seller would pay for May 30th. And now what we need to do, we'll go ahead and visualize this out again with our number line here. So again, we have January 1st, and over here we have December 31st. That's our tax year. Tax year in Florida is January 1st to December 31st. And I believe that's actually how it is in most states. So we have our tax year here. And again, our closing date's on May 30th, right about there. It doesn't have to be exact. This is just to help you understand this concept. So that's our closing. But now how I draw this as a line, that's not entirely correct. It should be at the very least just a little box that represents this day of closing. So that's our day of closing here. And now what we're trying to find out is, since the day of closing is charged to the buyer, this is going to be on the buyer side. So we'll draw a big kind of thick red line there. That's really where we're making our proration, because May 30th has to stay over on the side for the buyer. And remember, this is our buyer, and this is the seller. Now the question is, what do we need to figure out? What are we trying to find? Are we trying to find the seller days or the buyer days? Ultimately, what we want to find, and this does depend on the situation, if it's already paid or not, but when the taxes have not been paid, so the taxes have to be paid here, but remember, the buyer's paying for the whole year. Now, we don't want the buyer's days, because on the closing statement, it's going to record the transfer of money, and that's really all we care about, is the transfer of money. We really don't care about the buyer's days, because the buyer's not having to do anything with the money. They get to keep any time that's worth the buyer's days. So what we're trying to find here is our seller's days. This is going to be what we're trying to calculate out. The seller's time that they lived in the property, what their tax burden is. Because remember, it's the buyer that's going to have to pay the taxes, so we want to know what the seller's tax burden is, what their fair share of from January 1st. And now remember, May 30th is on the buyer side, so what we need to keep in mind here is we're only going up until May 29th. So we're only going to May 29th because May 30th falls on our buyer's side. That day of closing is on the buyer's side of the transaction. We only care about the seller's side. So what we need to do now is figure out the number of days on the seller side. So that's effectively what we're going to be calculating out here first, the number of days. Now you might be asking, John, what's the easy way to know the number of days? Well, the easy way is Google number of days. Maybe pull out a calendar and actually count it out there if you need to. I'm sure there's something you could Google to actually figure out the number of days from, because we have, we'll write that in here, January 1st through May 29th. Figuring out those number of days, that's what we need to figure out here. I'm sure I know there's calculators out there. I've actually used a couple of them before. But if you're taking your exam, you need to know this information here, or you don't have Google handy, which that's really not the case in this day and age. Maybe you're out of data. That's maybe the only time Google isn't available for you, and you don't have a Wi-Fi connection. But there's actually a way to do this old school without needing the internet to tell you how many days are from January 1st to May 29th. And that's literally counting the days, not having a calendar, just having it all in your head. And you're like, John, how am I going to remember which months have 30 days and which months have 31 days? The trick is, there's two ways to remember this. There's a rhyme. And the rhyme, it's grown on me. I never liked the rhyme to begin with, and I'll show you the second way that's my go-to. But the rhyme is 30 days, have September, April, June, November. So 30 days are in September, April, June, November. 30 days in September, April, June, November. You say that enough times, it's kind of got a little bit of a ring to it, and you'll just catch on with that. I had to say it a bunch of times because I started off, I was like, what, 30 days? I always feel like there's more months that have 31 days in it, but apparently not. It's just 30 days have September, April, June, November. September, April, June, and November are the only months with 30 days in it. So that's one way to go about it, but I always feel like I'm going to forget some stuff with that. So I've got my knuckles, because I never forget my knuckles. And the trick you want to use right here, let's see if we can get right up in your face with this here. What you got to do is you take your knuckles, and your knuckles are going to represent the months with 31 days in them. And you start. It doesn't matter what side you start with. And the key thing with this as well is making sure you do have a 4 knuckles here. I won't use the term normal, but it's probably what most people call it. So as long as you got some knuckles up here, you got 4 of them, this trick is going to work for you. You could start on the index side, you could start on the pinky side, you're just going to work your way across. So you have January. Notice this is on a knuckle, so it's 31 days. Then we go down to February, and now February, I'm sorry, but February is 28 days. You have to remember that. There's maybe that you dig down in this knuckle a little bit deeper, but you just got to remember February is 28 days. Then we get into March. March is 31 days. Again, we're on a knuckle. We're in between our knuckle. April has 30 days. And then we get over to, what are we at? May, 31 days. And then we go June, July. Now the key thing when we get to July, you're at the end. You're at your pinky. July and August, they're back to back with 31 days. So you go July, August, September, October, November, December. So that trick is really great because there's a lot of times you might need to know how many days are in a month. And you don't want to, you could just really kind of move right across your knuckles right that real easy, or maybe remember the rhyme. Whatever it is you need to do for calculating prorations, you definitely need to know the number of days. So what we just had there, since we only need to count out to May 29th, what we're going to have is January, February, March, April, and May. And now real quick, just so we don't get caught up in numbering these out, May, remember, we're only counting 29 days. We're not counting that 30th day of closing because that day of closing is on the buyer's side. We're worried about the seller's side, so we're only counting 29 days in May. That's really essential if you want to end up with an exact right number. And the whole purpose of doing all this math, whether it's on the exam or you're doing this math in the real world, is to find that exact right number. So we have 29 days in May. Now we can start from our beginning. January is 31. February is 28. March is 31. April is 30. And now we could go ahead and add all these together, whip out our handy-dandy calculator. Now this, my word of advice is to be very careful when you're adding these numbers because it's a very simple calculation, and that's where your calculator will turn on you. And it's not really the calculator turning on you, it's you not hitting the button or hitting a wrong button, hitting a 32 instead of a 31. So make sure you put this in there slowly. So we have 31 plus 28 plus 31 plus 30 plus 29. 149 days. 149 days. And now, again, since our calculator might turn on us here, we want to go ahead and double check this. 31 plus 28 plus 31 plus 30 plus 29 gives us 149. Okay, twice in there, I think we're okay. So 149 days is our seller's portion. So the seller lived in this property for 149 days in whatever year it is that we're dealing with here. If it's 2017, let's say this closing is occurring on May 30th of this year. So we have 149 seller days. 149 days. Now what we need to do is find a daily rate. We know how many days the seller lived in the property for. What we do now is find a daily rate of taxes. We break this tax number, the $5,493, down into a daily rate. So we take the 5493, and now this is going to be where some methods will vary. There's two methods really, two main methods. Really one method that's your accurate method. The other one's the quick, lazy, efficient way that doesn't give you accurate numbers anyway. And the whole point we're doing all this math is to find an accurate number. So it's the 360-day method and the 365-day method. Hopefully you know a year has 365 days in it. So why would we use the 360-day method? It's a little bit quicker. It assumes all months are only 30 days instead of our 5 months that have 31 days in them. So it assumes that all months have 30 days, and we have 12 months, therefore we have 360 days in a year. So you can see how it's a little bit quicker when you start working with these numbers, assuming all the months are exactly the same, but not all the months are exactly the same. So when we want an accurate number, we don't divide by 360, we divide by 365. That's called the 365-day or the actual days method. They call it the actual days method because this is actually how many days we have in a year. So this is our actual days method where it's 5493. We're going to divide that by 365. So 5493 divided by 365, and that's going to give us a daily rate of 15.0493151. And yes, I would leave that number in your calculator, and that's why we always calculate the number of days first. You calculate the number of days first, so you can leave that number in your calculator. You're just going to go ahead and take that now and multiply by the 149 days. So you just hit times 149. And then we have our tax rate amount, and now at this point we'll round. You always want to try to save your rounding as close to the end as possible so you end up with a more accurate number. You could charge fractions of a cent because we're really not paying on a daily basis. We're paying for this yearly basis here for this 149 days out of the year. So now when we get here, we can round. If we rounded right here to 0.04, you see it's 0.049. That's almost 5 cents. Yes, you could round it up there, but ultimately what that means is the seller is going to have to pay a little bit more, and that little tenth of a cent adds up when you multiply it out 149 times across 149 days. So you want to leave those long numbers in your calculator, whether it's on the exam or in the real world. Again, we're trying to find the most accurate number using this actual days method. So we're going to just take that long number, multiply by 149, and we end up with a total proration of $2,242, and it's 0.34795, which we could round up to 0.35. So $2,242.35. That is our proration for this particular property. And again, since this is the seller having to pay, we're transferring the seller's days to the buyer. This is going to show as a debit to the seller on your closing statement, as well as a credit to the buyer. So $2,242.35 debit to the seller, credit to the buyer. And that's how you'll see this on the closing statement. So what that means in the real world, if we kind of translate this out to something our client can understand for us here, is that they're going to get a credit, or they should expect a credit. That's the key word you want to use, because it's maybe the seller will be like, oh no, that's in the contract, they're not paying for it, and it's your job to read the contract. But you should always say you should get a credit of this amount. And if you want to be sure about that, make sure it's in the contract, and more so talk to the title company, because they're the ones that are preparing these closing documents for you to make sure everything does line up like this. So we have $2,242.35 debit to the seller and credit to the buyer. So credit to the buyer is going to receive that. So if they've got $2,000 in title insurance cost, that's okay, because they're getting $2,242.35 credited to them. Now, when they go to pay their property taxes, they'll probably wish they still had that $2,242.35, but you can't pay the property taxes if you don't own the property. So if they need that for the down payment or to go towards these other prepaid expenses and closing costs that they have, that's typically how this is used. If there is any money left over, they do get dispersed a check for this amount and say, okay, here's your amount that's left. And a lot of times that'll happen if they made a significant earnest money deposit that didn't need to be quite that high, and they still get these prorations where they get these credits back. So that's going to be the proration on the property taxes. And this, like I said, should occur on every single property, and usually does occur on every single property transaction, because that almost $5,500, that's a big chunk of money. That, remember, that's the buyer having to pay that in the following year. But now at least they're getting credited for $2,242.35 for those 149 days that the seller lived in the property. So that's our property tax proration. We're going to take another quick break, and when we come back, we're actually going to do the same type of proration, but we're going to do it for prepaid rent. So this is great if you're working with investors, you're trying to analyze investment property, you're trying to see how much of a credit you could expect in the form of prepaid rent. So stick with us. I'm John Carismo. You're watching Ask the Instructor.
When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment. Need help preparing for your exam? We've got you covered. Join us for a structured weekend review class where we'll cover the topics you need to know to pass your class and state exams. Class sizes are limited, so reserve your seat now by calling 813-928-0106 or registering online at tampaschoolofrealestate.com. Have you been thinking about starting a real estate career, but are struggling to find the time to go back to school? Allow us to introduce our revolutionary online course platform. At the Tampa School of Real Estate, we have used our years of education experience and student feedback to bring you the finest and best online course. Visit tampaschoolofrealestate.com. That's tampaschoolofrealestate.com, or call us at 813-928-0106. That's 813-928-0106 to learn more and register for our online course today. After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. Every Wednesday at 12 noon Eastern Time, we come to you to help you understand complex real estate topics such as property tax prorations and make them easy. Because as you saw going through this, yes, there's a lot to kind of keep in mind. This does look like a lot if you guys haven't gone through this. But hey, go back and rewind and you can watch this. And I've been told, I get told all the time, I talk too fast. And yeah, I do go a little bit fast through these things, but that's great for you guys watching online because this is all recorded. You could go back, you could rewind this stuff. If you're watching on YouTube, you could even put me in slow motion, so maybe I'm talking a little bit more normal speed. You'll be able to catch every little thing it is that I say. So definitely check out those recordings. You can find all the recordings on our Success Center. That's tampaschoolofrealestate.com/success. You'll also find a bunch of other great articles. You want to be subscribed to that if you want to be successful in your career in real estate. That's why we call it the Success Center. So definitely check that out. But before we went on break, we went through and did this property tax proration. Now, this is one that gets involved in almost every transaction. This next type, this is going to be if you're dealing with somebody maybe who's an investor, or, it doesn't have to be an investor. This could be somebody that's buying a property that's got a tenant in it, and they want to live in it. Now, how is that going to happen? How are you able to buy a property that's a rental property with a tenant in it and expect to live in the property? Well, you can't live in there at the same time as the tenant. And let's rule that out. I mean, yeah, you could, but that may be a little bit weird. And landlord moves in, they maybe not like that too much. So when you're buying rental property, the new landlord is going to be bound by the original lease. But let's say that lease runs out in a month. Let's say that lease is up in a month. At that point, yeah, you can boot your tenants out. And maybe you could try to evict them in the meantime if you don't want to wait that long. But hey, if there's only a month, you got to wait it out for the tenants, and you told them you're not going to renew the lease, all pretty much said and done there. And this could be you as an owner buying the property, wanting to live in the property, although there's tenants in there. You just got to make arrangements for the time that's in there. But hey, this prepaid rent proration. So that's what we're doing next, a prepaid rent proration. This is going to be another thing that's done in pretty much any sort of investment or income type of transaction where there are tenants on the property. But again, it can be used if somebody's moving into a rental property and they've only got 1 month left. They could use this money that they're going to get from this prepaid rent proration to kind of help use that money to get them a hotel or a short-term lease on an apartment or something like that until they can move into the property. So with this prepaid rent proration, the process is very similar, except for now we're not dealing with a year. We're just dealing with a single month. And now again with this, the whole purpose of this is try to find accurate numbers, because pretty much anyone could guess, okay, if you're in there 10 days, that's maybe about a third of the month, that's about a third of the rent we need to prorate, or if you're in there 20 days, that's about 2/3, oh, you're in there 6 days, okay. And you can kind of see what that is about, but that's not what we're trying to do with this math. We're trying to find the exact numbers for what this prepaid rent actually ends up being. So trying to find the exact numbers for this prepaid rent is definitely useful, because now this is going to be the exact number you should be seeing on your closing statement, at least if you're doing your numbers right. So in order to solve this, we don't need the tax amount, but we do need the rent amount. So let's say the rent amount is $3,500. So we've got $3,500 in rent. And let's say the date of closing is, let's pick June now. We were doing May last, so on. Let's do June 14th. So June 14th. Now, again, this does look like it's about halfway through the month, and you could probably already get a roundabout estimate for what that's going to equal out to. It should be around 1750. 1750 is half of that. We're a little less than half, so it's going to be a little bit less than 750. So you can already see how you can kind of get an idea of what these numbers are going to look like. But now what we need to do is actually find out what these numbers are going to be exactly. Again, we need to know day of closing, being charged to who, and again, let's say it's the buyer. Now, in property taxes, if the day of closing is charged to the buyer, that means the buyer's got to pay for an extra day of property taxes. So that kind of sucks there. But now with prepaid rent, we're not talking about money that they're paying. They're talking about money now we're receiving for rent. So yeah, maybe they're like, oh no, I don't want to be charged the day of closing. I'll have to I'll have to pay for the taxes for an extra day, that extra $15 we figured out. I don't want to have to be responsible for that extra $15. I'm already stretching myself to buy this property. But now we talk about the prepaid rent. Oh yeah, I want the day of closing. They're going to be fighting over fighting over the day of closing, as opposed to maybe between the buyer and seller also fighting over the day of closing for taxes. But now it's over, hey, I want this money. I want this extra day's worth of rent. And we're talking about $3,500 a month in rent. That's going to be a pretty expensive day when we're breaking this out over the number of days in June. So remember your rhyme, 30 days have September, April, June, November, or the knuckle trick, June is a 30-day month. And then again, just to illustrate this out, to see what we're doing here with this one, we have June. So we're going to do June 1st to June 30th. We don't care about the rest of the year, because on July 1st, guess who's going to be collecting the rent? It's the new buyer. The seller's not going to still be collecting rent. Now, if the rent is paid in an annual basis, which typically it's not, it's usually paid for almost always in monthly installments, that buyer's going to be able to collect it then. The seller's not going to stick around and keep collecting the month and rent and keep having to give it back to the buyer. Say, oh, here, I collected your rent for you. No, they're done with it once they sell the property. So July 1st, it's going to be the buyer that's collecting it. So we're only worrying about this one calendar month here, June 1st to June 30th. Our day of closing, again, remember, we're going to draw this out as a little bit of a rectangle type thing, because that's our day, June 14th, the day of closing. Now, the key thing we need to find out at this point, not really find out because we already know the answer, but what we need to understand is where this day of closing falls. So day of closing is on the buyer side. So right there, this is the buyer. This is the seller. So we have our day of closing on the buyer side because the day of closing is charged to the buyer. It might also use some wording on your exam, or you might hear about something like this in the real world, although this is a little bit more obscure way to actually say it. Midnight prior the day of closing, or midnight the day of closing. So midnight on the day prior, midnight the day of closing. So they can kind of see where that proration is actually occurring. But who it's charged to usually is the simplest, easy way to communicate this information. Your exam always won't be simple, easy to communicate. If you're having trouble with your exam, give us a call. We'd love to help you out. So our seller days and our buyer days. Now, where's our money? Our money's over here. Who needs our money? The buyer needs the money. But now this is where it's different than property taxes. So the property taxes, we're figuring the seller days. In this case now, we're figuring the buyer days. We're figuring the buyer days from June 14th to June 30th. June 14th to June 30th, because the seller gets to keep the money. Again, we don't care for the closing statement, or really at all for the transaction, the money that they're keeping. I mean, yeah, it might be interesting to know, and really you could just take this number and subtract it from $3,500, and you find out what that seller's share of the rent, how much it is they have left over with. But nobody cares about that. The buyer wants to know, hey, how much money am I getting? How much money am I getting for my tax proration? How much money am I getting for my prepaid rent proration? Mr. Realtor, Mrs. Realtor, we're going to be asking you these questions. They want you to know the answer. And even if your answer isn't 100% right, you should always preface that. Now, this is just my rough calculation here using an exact method. We'll have to make sure we're getting that day of closing. But if that's the case, and as long as the rent's $3,500 a month, these numbers shouldn't lie. So you always want to make sure that you don't misrepresent any information, but especially a knowledgeable, a skilled investor, they might already know how to calculate this themselves. And if they already know how to calculate this themselves, they probably don't expect much out of you. But let's be honest, the people that you're probably going to be working with, they're new to investing. They don't know. They maybe bought 1 or 2 properties before, and they probably didn't even understand everything on the closing statement. I talk to agents every day that don't even understand everything that's on the closing statement. So they don't expect them to just know this information. This is where you want to be the knowledgeable expert. And when you're the knowledgeable expert, they're going to be like, oh, that guy, that girl, I need to use them again. I need to use them again because they told me everything I needed to know for this transaction. They saved me money. They made sure I got money. Oh, I'd be losing money if I didn't use them. And that's the type of impression that you want to have with your clients. So we have our buyer days. Now what we need to do now is figure out our buyer days. And what I always recommend doing here, just so you don't make a mistake, because you might be like, yeah, can't we just subtract 30 from 14 and end up with 16? And you'll probably be right with that one. So let's go ahead and count it though, just to make sure. And this is what I recommend whenever in doubt, just to make sure you don't end up with a wrong number, because the whole purpose of this is trying to find the accurate information. If we're not finding accurate information, we're just wasting our time with these math problems. So we have July 14th, 15th, 16th, 17th, 18th, 19th, 20th, 21st, 22nd, 23rd, 24th, 25th, 26th, 27th, 28th, 29th, 30th. Oh, what did we come up there? That can't be right. That can't be right. Maybe I'm doing something wrong with my fingers. Let's go ahead and do a way. Now, this is probably going to be a little bit more professional way if you're out on an appointment or they're actually in front of a client. They probably don't want to see you counting on your fingers. So maybe, I don't know, maybe make some hash marks on a paper. So what we're going to do here, again, we're going to count 614 to 630. So we're going to count these number of days. So we have 14th, 15th, 16th, 17th, 18th, 19th, 20th, 21st, 22nd, 23rd, 24th, 25th, 26th, 27th, 28th, 29th, 30th. Would you look at that? We have 17 days. You know why? Because if you're doing 16 minus 14, you're forgetting about the day of closing. So that's why you need to make sure, until you get a full grip on this aspect of counting the day of closing, until you could do this without making mistakes, draw those hash marks, count on your fingers, because again, we're doing this to find accurate information. Without accurate information, we're wasting our time. So we have 5, 10, 15, 16, 17. 17 buyer days. 17 buyer days, not 16 buyer days. This is the math I see people get wrong more than anything because they've been taught 30 minus 14 gives us 16. That's true. Unless we're counting 14 as well. We're counting that 14th day, so that really makes it 17 days on the buyer side. 17 buyer days, not 16 buyer days. So that's a huge mistake, not just with this, but also with your property taxes over the year. Now, if you're going through and just subtracting that, which you really can't do when you're dealing with this on an annual basis, you're a lot less likely to make that mistake with property taxes. But rent, I see this all the time. People leave out a day. And hey, maybe you want to double check the title company's math. Make sure they're preparing that closing statement correct. Because you know what? Who's going to look like a shining star when you show your client, hey, look, the title company, they were trying to cheat you out of this extra day here. But, I told them, hey, look, that's not right. You did the math wrong. You didn't count that day up. Title company is probably not going to make the mistake, but hey, if you're double checking them and that does come up, who's going to look like the rock star? The title company will be like, oh yeah, what about that? They're probably not. They're probably a little bit more defensive about it. But when you know this stuff and you're confident about it, ooh, you're dangerous. You're dangerous there. So we have our 17 days that we need to calculate. 17 buyer days. And now our math that we need to do for this, again, now that we have the number of days, we need to break this up into a daily rate. We take our $3,500 worth of rent amount. So $3,500 divided by how many days? 30 days. We're using the number of days in the month now. We're trying to find the daily rate for every single day in June. There's 30 days in June, so we do 3,500 divided by 30. So we punch that in our calculator, 3,500 divided by 30. We end up with 116.66667, and so on. There's actually probably some more repeating decimals in there that's just not showing. Oh, look at that. There is more repeating decimals when it's rounding up like that. So you want to leave that number in your calculator, and that's why we figure out the 17 days first, because we could just take that, and now this is going to give us the most accurate proration, 116.6666666, as long as the 6's go on for in the calculator, which is pretty much indefinitely, times 17. And we end up with $1,983.33.333, and we'll just go ahead and leave that round down there. 1983.33. That is the most accurate number for our prorations for the 17 days. Now let's say, hey John, is this rounding thing really such a big deal? Is this really such a big deal? Do I really need to save the rounding? Is it hurting you? No, but let's see what happens when you don't. So let's go ahead and do the same math now on 116.67. Let's say you just rounded it to dollars and cents right there. So you have 116.67 times 17 days. Let's see how much it's going to change. It's not going to be a drastic difference. So really, you're probably going to be all right. But 116.67, I'm just going to show this to you here, just so you know I'm not doing any like voodoo with this math. 116.67 times 17. We've got 1983 and 39 cents. 1983 and 39 cents. So yes, there is a 6-cent difference here. And you're like, John, what do I care about 6 cents? So what's my client care about 6 cents? And the reality is they probably don't care about 6 cents. But let's say we've got 100 units that we're dealing with here. It's not $3,500 a month. It's $350,000 a month in rent. And that wouldn't just be 6 cents. That'd be $60. So now we're dealing into a little bit bigger money that we're dealing with here. So yes, you'd probably be all right if you rounded it right there. It's not going to make a huge difference. But especially if you're taking this on the exam, you want to see that same exact number. If you see 39, you came up with 33, and I'm like, oh, what did I do wrong? On the exam, if you save the rounding to the end, you'll probably be exactly lined up with what the answer is. You should always line up exactly what the answer is if you save the rounding to the end and you did everything correct. Now in the real world, yes, this is a little bit different. If you want to try to score your buyer an extra 6 cents, maybe try to do that rounding at the beginning. No one's probably going to catch it. It's only 6 cents there that we're talking about there, and it's just due to where you're doing the rounding, which there's different rounding rules depending on which type of accountant you talk to. So that could really go either way. But if you want the most accurate number, that's going to be leaving that number in your calculator and saving the rounding for the end. And again, that does make a bigger difference when we have larger numbers plugged in for what we're starting with. So we're going to take one more quick break, and when we come back, we're going to do interest on an assumed loan and figure out how to prorate that, because this is the most complicated one yet, so don't go anywhere. We'll be right back with Ask the Instructor.
When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment. Need help preparing for your exam? We've got you covered. Join us for a structured weekend review class where we'll cover the topics you need to know to pass your class and state exams. Class sizes are limited, so reserve your seat now by calling 813-928-0106 or registering online at tampaschoolofrealestate.com. Have you been thinking about starting a real estate career, but are struggling to find the time to go back to school? Allow us to introduce our revolutionary online course platform. At the Tampa School of Real Estate, we have used our years of education experience and student feedback to bring you the finest and best online course. Visit tampaschoolofrealestate.com. That's tampaschoolofrealestate.com, or call us at 813-928-0106. That's 813-928-0106 to learn more and register for our online course today. After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. Every Wednesday, 12 noon, we bring it to you to help you understand real estate concepts, to know how to do math, to know how to better serve your clients, to know how to make sure you're a knowledgeable professional in this industry that requires knowledgeable professionals. Real estate, it's all about the knowledge that you have and implementation of that knowledge, because it's great to learn this stuff here, but if you never use it, well, what's the point here? Now, let's get into our last little bit of prorations. We did property taxes. We did prepaid rent. The final proration that we have to do is proration on an assumed interest, which you may never use. So it may not be something that you really need to know, but if you understand prorations, the concepts are exactly the same. And that's really more so where this is going to help you, because we're covering concepts that are just like the previous concepts. We're just adapting a little bit now when we're talking about proration. So proration on assumed interest. And now, this really requires an understanding of interest, how it works, how it's calculated, when it's paid for, because that's really the foundation of being able to do a proration on assumed interest. So with interest, if you've gotten a bill before for any sort of financial obligation, whether it be a mortgage or a loan or a credit card or a student loan or whatever it may be, when you make purchases, that doesn't get billed right away. If you pay, and this is the great way to use credit cards, if you get, let's say we have June 1st here, and we have June 30th here. If you make charges during this month and you pay it on the next bill, you're not going to end up getting charged interest for it because you stayed within that 30-day revolving period. Interest is charged on previous charges. So anything from this last month, that's where you're getting the bill for your interest, is for the last month. So for May, if we didn't pay off all of our charges in May, or if we have a loan balance on our mortgage in May, or a loan balance on any sort of loan in May, we're going to get charged interest on what our balance is in May. That's how amortization of interest works. And that's going to help us understand this credit and debit concept here a lot better. So let's say we have a loan with a balance, because that's the key thing, is what the starting balance is for this. Let's say it's $50,000. Now, if you ever assume a loan, it's probably not going to be a $50,000 or a nice even number like that balance, but we'll just use $50,000 because it's going to be the same whatever we use this as. So that's going to be our loan amount. We need the date of closing, which let's say that now this closing is occurring on July 21st. So July 21st. And now we need day of closing. Let's say we're going to charge the seller the day of closing. Typically, it is charged to the buyer. I would say in most cases, it is charged to the buyer. This is up for negotiation, especially when we're dealing with large amounts of money. This is definitely going to be where we do see this negotiated. But it could end up on the seller. It could end up being the buyer. It could be either one of their expenses. Somebody's got to pay it if there is a proration like this. So we have our loan amount, $50,000. Now we're trying to do a proration on assumed interest. We're doing proration on the interest. We don't have a number for interest here. That's okay. You don't need a number for interest to be able to figure out the interest. What we have here is the loan amount of $50,000. Oh yes, we do need the interest rate. So I did leave out a little bit of information. You will need the interest rate. There's no way of magically knowing what the interest charge is without the interest rate. So let's say our interest rate is 4.5%. So our interest rate is 4.5%. We have a $50,000 loan. The date of closing is July 21st, and the date of close is being charged to our seller. So what we're doing here, again with that number line, so we have July, what we're working with in this case. So July 1st, July 31st. Again, yes, we are doing this on a monthly payment. But what I also want you to remember here is APR, annual percentage rate. I'm going to tie that back in a second. But remember right now that 4.5, any percent of interest you see, it's almost always an APR, A standing for annual percentage rate. So that's an annual interest rate we have there. So we have day of closing, July 21st. We got our buyer over here. We've got our seller days over here. Now, what number of days is it we're going to be figuring out? We already figured out day of closing belongs to the seller, so we know that we're going to draw our line right there because the day of closing is being charged to the seller. The seller is having to pay for this day of interest because that's what we're trying to figure out here. Notice we're not prorating the principal balance because that's going to be the breakdown of how much this decreases our loan amount. We're prorating the interest that's being charged for this month. So we're taking the interest for this month and figuring out what portion of the time the seller lived in the property to pay the buyer. How do we know it's the seller paying the buyer for this interest? Well, when is this interest going to be charged? For the month of July, the interest isn't going to be charged until August. Because remember, interest is always charged for the previous month. So the buyer is going to have to pay for July's interest in August. In August, they'll pay for July. September, they'll pay for August. October, they'll pay for September. And it keeps going backwards like that, where you're paying for the previous month's worth of interest. So what we need to do is figure out the seller days, which we're counting the full 21 days in July here. And yes, you can number these out just to make sure, but now when you're dealing with the seller days, that's usually a little bit more straightforward. It's the buyer's days that almost always trips people up with this here. And especially if we look at this, 31 minus 21 is 10. And that's true if the day of closing is being charged to the seller, but we're also counting July 21st. And that's why I say you got to keep in mind who the day of closing is charged for, because if this day of closing was on the buyer's side, it wouldn't be 10 days we're counting, it'd be 11 days we're counting. So you definitely got to be cognizant of that. So we want our seller days, which our seller days is 21 days. And let's make some room here, because this one is actually the most extensive calculations and the most extensive math that you will have to do. So we have 21 days that we're going to be accounting for. So what we need to do, again, find a daily rate. And now this is where it gets, a lot of people confuse this with just regular mortgage amortization, because normally to find your interest for any given month, you take your loan amount, multiply it by your APR, and since it's an APR, you then divide it by 12 to figure out that 1 month. Well, we're trying to find a daily rate. If we're trying to find a daily rate for just a single day, not an entire month out of a year, we're not going to divide by 12. We're going to divide by 365. We're going to take that annual rate, and since we're trying to find daily, just jump right to dividing by 365. Because if we divide by 12 and then we divide by the number of days in the month, that's our 360-day method, which we already established isn't the most accurate method. So what you need to do here is take our loan amount to $50,000. Multiply that by our interest rate, and that's going to be 0.045, and we turn that into a decimal. And then divide by 365. This is going to give us our daily rate, $50,000 in loan times our 4.5% rate of interest, which is going to be 0.045 when you put that in your calculator, divided by, so that gives us our annual interest of $2,250, divided by our daily rate, or our total number of days, 365. We end up with a daily rate of $6 and 0.1643856. And yes, you could probably round it here. You will be off by a couple cents from the most accurate number because you want to save the rounding towards the end. But then we're just going to go ahead and take this, multiply it by our 21 days. And we end up with 129.45. So you can see it's actually really not that much math at all. That was me lying to you guys. It's not really much math at all, so that's why you should probably just kind of keep this one in your noggin. If you understand those two previous concepts on how to do a proration, if you ever do get confronted with an assumed loan where you have to do proration on the amount of interest, or double check the proration on the amount of interest, it's really not that different. We're getting a daily rate, multiplying it by the number of days, and we're done. That's it. It's really understanding this concept of how a proration works. And if you're able to do that, all these prorations are very similar and they get very easy. So we have $129.45. Remember, that's our seller paying to the buyer. So again, we're going to have debit to the seller and credit to the buyer. And that's it. We're done. We did it. $129.45 would be the amount of interest. And now that extra $130, you'd be like, is it even worth it to do a proration on just the interest portion? Even if the loan's only $50,000, it's $129.45 worth it. And if we're dealing with a much larger loan, say it's a $250,000 loan, that's going to be a much bigger number that we've got there. Say we've got a higher rate of interest, that's going to be a much bigger number there. So yes, absolutely, it is worth it. I mean, in the grand scheme of things, it is going to seem like a nickel compared to the rest of the transaction. But hey, that $129.45, that's going to take you and somebody else out for a very nice dinner and dessert and maybe a couple of drinks too. Lots of money there in terms of all these different charges. So definitely don't want to leave that one out. And that's our proration on assumed interest. And that's really our three main types of prorations. Really the two main types of prorations plus the proration on assumed interest. And as you can see here, when you start taking these more obscure things like assumed interest, you could really prorate almost anything when you understand this concept. You figure out whether it's a monthly or an annual charge. You figure out the number of days that you need to prorate, the number of days, which in this case was 21 days. Figure out your daily rate of whatever that charge is, and then just multiply it out by the number of days. And there you have your proration. Very easy. Debit to the seller has to pay. Credit to the buyer is to receive the money. And you're done. That's it. That's all you need to do. So that's all I got for you guys today on prorations. I hope you've enjoyed the show. I've had fun telling you guys about prorations. I have fun doing math. I'm weird like that. So not really doing the math because the math it is what it is. I do have fun teaching you guys and explaining these concepts and breaking it down in simple terms because everybody likes to look at this stuff and say, oh, this is so difficult. How am I going to be able to figure out a proration? I got to find interest and I got to do this. Dude, it's easy. Loan amount times interest rate divided by 365. Times 21, and you're done. And yes, you do have to understand. The key thing here is the understanding, what you have to do. But practice these steps. And that's my one tip of advice for any of these math problems. You practice these steps, you're going to start to learn these better. When I started in real estate, I didn't understand all this math, and I was relatively good at math. Math was always my strong subject where I could always figure out how the numbers worked out and I could maybe play with them enough, but I really never understood how this works. Once I understood how this all broke down, prorations became very easy because you're understanding the concept and you know how to apply that concept. So like I said, just practice these and you'll get strong with them. You'll get confident with them. Maybe practice the property tax one or the prepaid rent ones probably more so than this one because those are the ones that you're going to see more so in the real world. But hey, that's all I got for you guys today. Again, I hope you've enjoyed it. Join us next Wednesday at 12 noon. We're going to do another Ask the Instructor episode, and make sure you tune in this Friday, 12 p.m. We have what's called State of Real Estate, and this is going to be our mastermind. So this is where we kind of help you grow and enhance your real estate business. We're not talking about math at that point. Maybe there's a couple numbers that are brought in because there's no way to get away from the numbers in the real estate world, but we're talking and focusing more on how to brand yourself, how to prospect, how to do a listing appointment, buyer appointments, all these things that you need to know to really grow and really just run your real estate career. So definitely check us out Friday at 12 noon, Wednesday at 12 noon. And hey, we got another show coming for you guys soon. A third show. I can't let you details out on that quite yet, but stay tuned. You can find all the stuff. Like I said, make sure you subscribe at the Success Center. I'm John Chrismo. I'll see you next week.